Okay, let's unpack the foundational concepts of investing and saving. For most of us, our financial life is kind of stuck in the present, right? We're always focusing on that daily or monthly budget. But the real power, the ability to build true, lasting wealth, that comes when you move beyond just paying bills
Yeah.
to actively growing your money over time.
That's the critical shift. And investing only really begins when you've managed to accumulate savings. Money that's been, intentionally earmarked for the future. That saved money is what we call your principal or your capital.
Yeah,
You really do need the wood before you can build the fire.
absolutely. And when we talk about foundations, we are diving into sources that cover, well, everything, from basic savings discipline all the way to some incredibly specialized tools. So our mission today is to give you that blueprint. We're going to explore the timeless principles that guide every smart financial decision. We'll cover everything from the psychological tricks of saving to the actual math of future wealth.
And while we're building this foundation, we should probably give a quick nod to one unique product mentioned in our sources: segregated funds. These are basically deferred annuities, and they're exclusive to the life insurance industry. They're specialized because they're structured to provide specific guarantees to investors, which is something we'll circle back to when we get to risk management.
Perfect. Okay,
Yeah.
so let's start at the starting line, the discipline of actually accumulating that capital.
Mm.
If investing is the marathon, then I guess saving is the foundational training.
Yeah.
You have to get that principle ready before you can earn any kind of return. But the number one hurdle we always hear about is just consistency.
Yeah.
So how do we simplify wealth accumulation so it actually works in real life?
The overriding principle is really behavioral. Saving must be treated exactly like any other expense on your budget.
Like rent or your phone bill,
Exactly. It has to be non-negotiable, something you commit to before you figure out your disposable income.
which of course gives us the classic and still probably the most effective piece of advice.
Mhm.
Pay yourself first.
That's right. I mean, if you make savings an item that's deducted immediately, you just reduce the temptation to spend it somewhere else. And the best way to enforce this, to sort of eliminate that friction, is to use technology. Set up a pre-authorized contribution, a payake. It automatically moves money into your investment account every payday. It's friction-free. The capital gets built whether you feel disciplined that week or not.
And as for a benchmark, our sources all seem to point to saving about 10% of your take-home pay. Now, I know for a lot of people listening that can feel, well, impossible, especially right now. Why start with 10%?
Because it's historically been proven to be that tipping point. It's where the growth accelerates enough for you to actually feel it, which reinforces the habit. But look, it's a starting point, not some religious rule. If 10% isn't feasible, start with 3%. Then maybe increase it by 1% every 6 months. The consistency is what's important, more so than the amount. But 10% gives you a serious target.
I think that's crucial. Just start small and make it automatic.
Mm.
So beyond the regular paycheck, what else should we be capturing?
You should really focus on saving those exceptional payments, that money from an income tax refund or a work bonus, even a sudden inheritance. That's capital you hadn't budgeted for. If you never expected it, you won't miss it. Save all of it.
And to keep motivation high, I love the concept of dedicated savings buckets.
Oh, it's huge. It connects your money to emotion. If you assign money to a specific motivating goal, a down payment, retirement, a big holiday, it is so rewarding to see those goals being reached. That visual progress reinforces the good habit, much more than just dumping it all into one big, savings account.
So once that discipline is set and the savings, your principal, built up, we make the transition.
We do. And investing is simply the process of taking that capital and strategically buying financial products with one goal, making a profit, which is what we call the return.
Okay, let's talk about those returns, because this is where the risk really starts. The results can fall into, three obvious camps. Positive, where you make a profit. Neutral, you basically break even, get your principal back, plus fees. Or negative, you take a loss. And that potential for loss, of course, is the risk.
And that return is always quantified as a rate of return, usually a percentage. Now, the whole spectrum of risk, it really revolves around the guarantee or the lack of a guarantee on your principal.
Right. So if an investment is guaranteed, that means the full amount you invested will be repaid plus some kind of profit. That's a powerful promise.
It is. Products like guaranteed investment certificates, GICs, or certain government bonds, they operate under that promise. On the other side, the non-guaranteed side, you've got stocks, mutual funds, real estate. There is zero promise your principal will be repaid. You are completely exposed to the market.
And you can immediately see how this plays into different investor profiles. Our sources give a great contrast. Someone like Jean, who's 78 years old.
Right. Jean depends on her investment returns for her retirement income. She literally cannot afford to lose her capital. So for her, it's a no-brainer. Jean chooses guaranteed investments. Her priority is capital preservation, not massive growth. Her risk tolerance is just naturally very low.
And this is exactly where those specialized products we mentioned earlier, segregated funds, kind of fit in. They are insurance investments, and they provide guarantees. They often protect the principal from market downturns, maybe at 75% or even 100%, as long as you hold it to maturity. So they provide that safety net, usually for a fee.
And moving to the broader context, we use the investment risk scale. It ranges from very low risk all the way up to aggressive risk. Aggressive is where you knowingly step into a situation where you might not get all your money back.
But you're aiming for a huge upside.
Exactly.
So why would someone in their 30s or 40s consciously choose to take on that aggressive risk?
Well, that brings us right to the core engine of finance, the risk-return theory. It just states that risky investments give you the opportunity for far greater positive returns than low-risk ones. The market rewards people who are prepared to risk their capital with a potentially better return. If you aren't willing to risk loss, the market says, okay, you should expect a lower return because you're demanding certainty. It's a direct trade-off.
So if the risk-return theory is the engine, then compounding is like the turbocharger. This is where it gets really interesting. We have to talk about compounding or compound interest because it's just fundamental to building wealth.
Yeah, it's been called the eighth wonder of the world for a reason. Compounding is just the idea of earning interest not only on your original principal, but also on the interest that has already been paid and then reinvested.
Let's just visualize that for a second.
Oh.
In year one, you get interest on your principal, but in year two, you're earning interest on the principal plus the interest you already earned in year one. By year five, the pile of capital you're earning interest on is just dramatically larger.
The growth curve doesn't just go up, it bends sharply upward over time. And this is why that classic advice is so true. Compounding is just so effective over a long period. Time is money's best friend. It gives that snowball the maximum runway to pick up speed.
And we really have to emphasize the urgency of time here. Let's say you start saving $5,000 a year at age 25. By 35, you've put in $50,000. Now imagine someone else starts at 35 and contributes the same amount.
The person who started at 25 will have, significantly more wealth by age 65. We're talking hundreds of thousands more, maybe. Even if they stopped contributing completely at 35 and the other person kept going, that early accelerated compounding is the single greatest advantage a young investor has.
So the critical condition then for this magic to work is that all the returns have to be reinvested. The moment you start making withdrawals, you shrink or even kill that effect.
And now for the necessary dose of reality, compounding is impartial. Debt also compounds negatively against you. If you're paying 20% interest on a credit card, that compounding is actively working against everything you're trying to save.
Speaking of reality checks, the return you see on paper only matters in relation to how much prices are going up. This is the difference between making money and actually becoming wealthier. We have to talk about nominal versus real return.
Nominal return is the stated, advertised rate. If a GIC advertises a 3% return, that's the nominal rate. That's what's on the paper.
But the real return is what actually measures your purchasing power. And you calculate it by taking that nominal return and subtracting the rate of inflation. This tells you if your money can buy more or less stuff next year.
Let's use that GIC example. In 2020, say your GIC paid a 3% nominal return and inflation was 1.8%. You had a positive real rate of return of 1.2%. You made a real profit. Your purchasing power went up.
Okay, now skip ahead just 2 years to 2022. Same GIC. Still pays 3% nominal, but inflation has spiked to 5%, and we all saw this happen. Your real rate of return was actually negative 2%.
And that's the aha moment right there. Even though your statement said you earned a 3% profit, you lost 2% of your purchasing power because everything you wanted to buy got 5% more expensive. This is why just beating inflation is the first, most basic goal of investing.
Okay, moving on to strategic management. How do we apply these principles to, protect our capital and maximize returns? First, let's define the building blocks. Asset classes. These are just categories for investments with similar characteristics.
Right, and the sources outline the three main ones: stocks, also called equities; bonds, which are fixed income or debt; and cash, which means money market instruments. And then you also see real estate and commodities listed as two other big ones.
Having these different classes leads us to the critical concept of diversification. What exactly is that, and why is it so essential?
Diversification is just the strategy of spreading out your investment risk. You do it by combining various asset classes and also different investments within those classes. It's the simple, time-tested wisdom of not putting all your eggs in one basket.
So how does an individual actually achieve that? Effective diversification.
Well, you could buy stocks across a bunch of different industries and countries, tech, healthcare, energy, whatever. Or you could buy bonds with different maturity dates and risk profiles. But here's the reality. If you, as an individual, only have, say, $20,000 to invest, trying to buy one share of 50 different stocks, it's just not going to give you meaningful diversification. And it's expensive.
Yeah, most individual investors just lack the capital to do it on their own.
Exactly. Which is why pooled investments are so vital. When you buy into pooled funds like segregated funds, mutual funds, ETFs, you automatically get the benefit of diversification. The fund itself is already invested across hundreds, maybe thousands of different holdings. It's just the practical, capital-efficient way to manage risk.
The final concept we need here is liquidity, and this relates directly back to money you might need on short notice.
Liquidity just describes how easily and quickly you can cash in or sell an investment at or near its current market price. A savings account is highly liquid. You know its value. You can get the cash in minutes.
Whereas an illiquid investment would be something like a piece of art or real estate. I mean, even
Sure.
if you find a buyer right away, there's a huge time lag between the sale and actually getting the money.
This is a crucial distinction for planning, especially when it comes to your emergency fund. You know, that 3 to 6 months of earnings you set aside for emergencies, that money must be highly liquid. You need quick, easy access to its highest market value, so it should be in cash or a high-interest savings account, not tied up in illiquid real estate.
And now we get to the mathematical principle that really governs all of finance, the time value of money, TVM. This principle is just based on the idea that a dollar today is worth more than a dollar tomorrow. Why? Because the dollar today has the potential to earn interest and grow over time. Okay, let's break down the two sides of that coin. First, present value, or PV. This is where we work backward from a goal. The question it answers is, how much do I need today, the present value, to hit a specific savings goal in the future?
It's the tool for big planning, figuring out how much you need to save today for a kid's university in 15 years, or what lump sum you need for retirement. And the key principle is that you need to save less than the future goal amount today, because that initial sum is going to earn interest and grow into the target.
So if Julie needs $5,000 in 5 years, and she can earn a decent interest rate, she can start with a lot less than $5,000.
Precisely. And the higher the interest rate she can get, the less she has to put in up front. If she earns 3%, she needs one amount. But if she can lock in 4.5%, she needs several $100s less to start with. The rate works inversely.
Right. And now for future value, FV, which works the other way, forward.
Future value answers the complementary question. How much will a sum I invest today be worth in the future? This is what someone uses to project how much their current $100,000 nest egg will be worth in a decade, assuming some steady rate of return.
Let's use the Sam example. He invests $5,000 today at a 3% annual interest rate for 5 years.
By the time 5 years have passed, that $5,000 will be worth nearly $800 more. And this isn't just simple growth, it is that compounding effect, interest on top of interest.
And just like with PV, the interest rate changes everything. If Sam manages to invest that same $5,000 at a higher rate, say 4.5%, the final future value is substantially bigger over the same time. The math just confirms the risk-return theory, right? A higher rate dramatically accelerates the compounding and boosts the final payout. So what does this deep dive mean for you, the learner? We've covered a lot today, from the psychological discipline of setting up savings buckets and paying yourself first, to understanding that accelerating curve of compounding and the critical difference between the money you see on paper and the money that actually matters, the real return. We've given you the core principles to really define your financial objectives.
And if we connect this to the broader context of financial planning, well, the core duty of any advisor is to assess a client's needs, analyze the products, and then propose a recommendation that is in their best interest. Understanding these fundamentals, risk return, time value of money, diversification, is absolutely essential for tailoring a successful strategy that actually aligns with your specific goals.
And since those segregated fund contracts are unique to the life insurance industry and provide guarantees that protect against market loss, often 75 or even 100% of your principal, it raises a powerful question for your personal strategy. How might the safety net offered by these insurance investments change the way you approach the aggressive end of the risk-return scale? If you know your capital has a measure of safety built in, does that allow you to be more ambitious with your potential reward? It's a crucial calculation of security versus upside, something to mull over as you define your next investment move.